In this video, we'll talk about the present value of growth opportunities. So, as we have seen from previous videos, that it is the firm's choice whether to pay out its earnings as dividend or to keep it as retained earnings for plowback or for reinvestment so that the firm could grow. Okay, so what is the price impact or the valuation impact for a firm with or without the growth? Okay, so we'll illustrate with a very simple example here using the same firm. So before we go into the example, we need to know the EPS or the earnings per share. Okay, so since we're always going to price a stock on a per share basis, so we need to keep everything consistent. So the earnings here are also on a per share basis. So it's calculated as the net income divided by the number of shares. Okay, so try not to confuse it with the ROE. ROE is a percentage, but the EPS here is a monetary term and it's in its absolute value here. Okay, right. So let's say there's a firm with the first period is EPS of 10. The required return is 10%, or the discount rate is 10%, but it has zero plowback, meaning it has zero growth. Okay, so how do we put a price on it? So with zero growth, your EPS simply becomes your dividend. Okay, so no growth means everything you earned has been paid out to the shareholders as dividend. Okay, so if we want to put a price on it, then it's simply D1 divided by R. So assuming the R is constant over the time period. Okay, so it's going to give us 10 divided by 10%, which is 100 here. Okay, so the price per share, or the price of the stock, is going to be 100. Okay, so in the next example, let's say there is a bit of growth. So it's the identical firm with the same earnings ability here. So the EPS 1 is going to be 10 as well. The discount rate is 10%, but it has a bit of growth. So to calculate the growth, we will need the ROE and the plowback ratio. So in this case, the ROE is 20% and the plowback is 40%. So from the previous video, we should know the growth rate of this firm is going to be ROE multiplied by the plowback ratio, which is 8%. Okay, so the size of the firm is growing at 8% as well as the dividend. Okay, so let's put a price on this firm. So the price is going to be D1 divided by R minus G here. But be careful, the D1 here is not the same as the previous one. It's no longer 10 because we're reinvesting some of these earnings here. We're only giving out 1 minus 40% as the dividend. Okay, so do not use 10 here, but rather you need 10 multiplied by 1 minus 40% here. Okay, so you get 60% of that earnings as your dividend. Okay, so the discount rate is still 10% and the growth rate is going to be 8%. Right, so now we have 6 divided by 2%, which is 300 here. So as you can see, the difference between the valuation here. The firm with growth is valued a lot higher compared to a firm without any growth. Okay, so the difference here is the present value of the growth opportunities. Okay, in this case it would be 200. So intuitively, this is the difference in the value of the firm should the company decide to plow back some of its earnings, and the plowback ratio is 40% in this case, right? So if it's not doing that, then becomes the opportunity cost, right? Or the foregone opportunity, which is the difference between an all payout firm or all dividend firm versus a firm with growth. Okay, so we can generalize this into a single formula here. So the price is going to be the EPS 1 divided by R plus the present value of growth opportunities. Okay, think of the price here as a firm with growth, and the EPS 1 divided by R is the firm without growth. Yeah, so in this case, just like this case, right? So without growth, your EPS 1, which is your first earnings, is going to be your dividend, right? So this is the no growth firm, this is the growth firm, and the difference between their prices is the present value of your growth opportunities. Okay, so in our next video, we will try to rearrange this, and we'll see what comes up. Something interesting will come up, and how do we interpret that. Okay, and I'll see you in the next video.